do a 3-hour webinar that is about presenting how to invest in 10x stocks. I'm going to jam it into 20 minutes here. Briefly, if you're unaware of what Keystone does, we've been in business for about 25 years. We do the research. How do we do it for you? We look at every stock in Canada, from small caps to large caps. We look at about 6,000 in the US from a fundamental balance sheet, GARP, or growth at a reasonable price perspective. You use a discount brokerage and you save on fees and you subscribe to our research on an annual basis, and we help you build simple 15 to 25 stock portfolios. Okay, housekeeping. I got a lot of slides here today. Feel free to take notes. You want to come up to me at the end, I'll give you a card and we'll fire those slides off to you. All right, so I'm not going to get into a summary here. I'm just going to get right into it. So essentially, I'm saying, why should you take our advice at all? Well, this is what I presented here in the room last year. You can see 3 of the 4 stocks are higher, 34% average gain. The year before came here. We happened to recommend what was the best performing stock in the entire Toronto Stock Exchange over that period, Hammond Power. The other companies on there, tremendous gains as well. The average gain over that period is about 170%. So that's presenting some proof of concept that we kind of know what we're talking about, at least a little, in this segment of the market. Now, in terms of 10x stocks, why should you take our advice on whether we can find you the next 10x stock? Well, you can see here, these are actual 10x stocks that we have recommended to our clients. Recommended, bought, executed on, and some continue to hold today. And not just 10x. In terms of Hammond Power, the stock has gone up 200x since our original recommendation. So you can see there, and that's going to dovetail well into really my first segment today. It's a very simple concept. Why do we search for 10x stocks? It kind of should be self-explanatory, but it's one thing that we don't hear very often is that investing in 2 or 3 truly great companies can have a massive impact on your portfolio and can be game-changing within your portfolio. Now, this may sound like hyperbole, but it's not. Don't take my word for it. You could take Warren Buffett's word on this. In his 58 years of investment management, his gains boil down to about 12 truly great investments in the Berkshire Hathaway portfolio. That is about 1 every 5 years, and that has made him one of the richest humans on the planet. So to give you an idea of how impactful truly great 10x stocks can have on your portfolio, I put together a real-world example here. This is if you would have bought Boyd Group, one of our recommendations 15 years ago when it traded at $2.30. Today it trades at around $216. You had a portfolio of about 500,000. Divide that by 20 stocks, 25,000 in each company. Today's value of that stock alone would be 2.5 million. Same example with Hammond Power, it's worth 4.87 million today. If you had $1 million portfolio, take 20 stocks, divide it by the million, you're getting an equally weighted position in each, 50,000. So that value of Boyd would have been about 5 million. The value on Hammond Power is just under 10 million. So it shows you the truly great power that these great capital compounding stocks can have in your portfolio. Literally, your 20 stock portfolio, all other stocks could have went to 0 and you'd still be doing well in that portfolio. Now, of course, we're not looking for every stock to go to 0. We're also looking for those other 19 companies to perform well over the long term. But it allows you to have some losers in your portfolio because you will have them. All right, let's move on here. We're going to look at where to find the next 10x stock. What I'm going to look at is some past successes. I put these up here really to show you what we've done in the past and to make us look smart. It makes me look smart putting that up there. I'm kidding you. What I really put these up for is because it shows you that we've done this in the past, but it also shows you and it allows us to examine what are the commonalities between these 5 stocks and can we replicate that success going forward? And that's what we're going to look at today. To start off, I'm just going to look at the commonalities between these. Now, all of these companies, we'll talk about when we originally recommended them, how large were these businesses? Well, they were all under 55 million Canadian in market cap. So that is certainly a small cap in the Canadian market. It's a micro cap, essentially. So each started off small. So your commonality number 1 in these businesses when you're trying to identify a 10x stock is they start small. Number 2, let's look here. is there any commonality in the industries? Is there a particular sector that is particularly acute, and you can find a sector that will produce more 10X type stocks? Well, we can see here, you got electrical equipment and parts, automotive repair and servicing, you got paint, film and protection, engineering, software. So we can see here that there's absolutely no commonality between these segments. So you're seeing that there's something far more specific and far more significant at play than just a sector in terms of driving the 10X opportunities here. So we're gonna not check this one off. This is an X in terms of industries. Then we're gonna look at financial metrics of these businesses before they started their ascent. Did these companies have revenue? Was there a proof of concept in these businesses? So you can see, ding, 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 all of them had revenues there before their ascent. Now, we're gonna use a more stringent criteria here. It's profitability. Net income is a more stringent criteria. Did all these companies have net income before they started their ascent? And yes, you can see that. So statistically speaking, and financially speaking, profitability is a more stringent method than looking at just revenues. So we're going to use profitability as our commonality number 2 between these businesses before they started their 10X ascent. That is number 2, is profitability. Now, number 3 is, was there any awareness? Was there a lot of coverage on these companies when we originally recommended? Well, in terms of coverage, Hammond Power, Expel, Waterfirmus had 0 coverage on our original recommendations. In fact, it took over a decade for any real coverage to come on Hammond Power. Expel finally got coverage when it jumped to the NASDAQ from the TSX Venture. Boyd had previous coverage, but it was abandoned. And Jana had a singular non-independent analyst looking at the stock. So generally, unless you were a client of Keystone's at the time, you didn't find out about these companies. They were unknown in the market. So that's our commonality number 3 if you're looking to find a 10X stock. So I'm going to put that together. The basic commonalities, anecdotally, through our research that we look for, prior to ascent, on recommendation. They're all small, they're all profitable, and they're all unknown. No big bank buys on these businesses. And that's where you can find these mispriced companies. Now, does the data, that's our anecdotal research perspective. Does the data align with what we're seeing here? Well, let's look at it. There's a recent study done by Jenga Partners of all 10X stocks globally in a study period between 2012 and 2022, so a recent study period. It found out that 87% of all global equities that went up 10X or 1,000% started as small or micro-cap companies. Now, it also found that 82% of those were profitable prior to the start of their ascent, and 91% had some history of profitability. So the key is small, profitable, and unknown. And the data bears that out, and so does our anecdotal research. This is why we focus on profitable small cap stocks when you're looking to find a 10X stock. If you want some further research, the infamous or famous Henrik Bessenbinder, if I can say his name, he did a study. It's called Do Stocks Outperform Treasury Bills? He studied 26,000 stocks. That's enough to really get a good gauge on that. Between 1926 and 2015, the answer was yes, they did outperform stocks. But the significant variable here that he found in his research was that net income growth powered those returns. That's why you're looking for net income growth. Further evidence to support our strict adherence to finding profitable businesses to find 10X stocks. You want charts, you like charts to show you that this is an area to look in. This is a chart on just essentially $10,000 in, or $10,000 invested in small cap versus large cap. It's over a significant period of time back to 1926. Large caps would have returned you about $10 million. That's a good return, 10,000 to 10 million. Just put in small caps with that outstretched returns and gains in that sector, your $10,000 turned into $1 billion over that same period of time. So I'm not a mathematician. I'll take the billion over the 10 million there. Now, I'm going to finally end this section by quoting this guy. Many of you may know him. This is a man who pines for the day that he could go back to when he was investing in small cap stocks. He said, it's a huge structural advantage not to have a lot of money. I think I could make 50% a year on $1 million. For him, that's not a lot of money. Now, he says, no, I guarantee I could do that. Now, unless you have several $1 billion in loose change kicking around in your pockets, you can play in this segment, and it is one of the only advantages that you have over Warren Buffett. Trust me, you don't have any other than this, basically. So take advantage of it. Buy profitable small cap companies. This is the way to find the next 10x stock. All right, why small caps though? Why do they outperform? Well, the data shows that small caps do outperform. There's no silver bullet that we can point to exactly on why, but there's many theories. I'll go through a couple of them right now. Why the outperformance? Well, higher growth rates and higher growth prospects in this sector segment. It is essentially easier, just by the law of large numbers, to grow from $1 million to $2 million in terms of revenue or profitability growth than to take a large company and go from $1 billion to $2 billion. You find, there we go, that's what it says there too. Now, you find that there's a lack of coverage, greater chance of mispriced stocks to find. Often when Keystone finds these individual gems in the market that are kind of been thrown out, babies that have been thrown out with the bathwater, we're the initial only coverage on those companies. So you have the potential to find a mispriced security. Why? Because if you look at a large cap company, many in the US have hundreds to even thousands of analysts and financial advisors covering them at any given time. They're more efficiently priced. If you have one or two analysts looking at them and the market isn't as aware, you have better chance of finding a mispriced stock. So let's look at the relative opportunity. This is today. That looks like a bit of rainbow spaghetti on there, but really what I'm looking at is the valuation gap right now between small caps versus large caps, and it is at a significant divergence right now. Now I'm going to see, right now we're looking at about the S&P 500 at 21.2, and this is the small cap index, the small cap S&P 600, it's about 15.2, price to earnings multiple. Now the gap was higher about a year ago. It was a great opportunity to buy great companies at that point, but it's narrowed now, but it's still a 40% gap between the two. That's your opportunity. To put that in perspective, if you look at the better part of this century, small caps actually traded at a premium to large caps. So you're now seeing that flip. If it flips back, the inversion of that flips back, it can be a powerful source of total returns over the next couple years. All right, that is your opportunity there. The inversion ratio flipping back. Again, it held for the first part of this century, 20 years. Small caps had higher PEs than large caps. So if that flips, again, it can be powerful in your portfolio. All right, let's look at 3 to 5 profitable stocks that we can get to. I got 7 minutes. I'm going to have to bust through this really fast. First company I'm going to look at, when in Rome, I'm going to talk about a mining company, but it is a lot different from many of the companies here. This is a company that mills ore in Peru. They don't mine it. So they've had a track record of profitability, which is what we like. I said that word a lot today. But they currently operate a mill in Peru where they produce ore from their government-purchased registered producers, essentially small-scale miners bring them the ore. They process it at their mill and sell it on the global scale. The company has a very simple business model. Their margin is between the price of ore purchased and the market price of gold. The higher the margin, the better. They also operate on throughput or efficiency. The more ore they're putting through the mill, the higher the efficiency, the better. A higher gold pricing environment, like we're seeing right now, is great for this business. It pushes more small-scale miners to bring them ore supply, and they keep making more money. That's why we like it. We've recommended this company since it was $1.40, $2, about $6 today. It didn't have a dividend, and they instituted a dividend. I'll show you that right now. So why do we like it? 12 consecutive years of profitability. In the mining sector, you typically see this. This company has done this over time, not just this. That's what we like to see. Very strong balance sheet. 20% of the entire market cap is in cash, and they make US dollars, so real cash, not Canadian dollars, which is great to see. Dividend growth stock, we like that. Compound annual growth rate in this company in terms of dividend is about 23% over the last 5-6 years. And we expect them to up their dividend again this year. Reasonable valuations on this company, growth and diversification. I'll show you the growth, 5 years of sales and net income right there. It's boring, but it produces great returns in the market. This is their last quarter. Again, 16 cents per share, up from 7 cents. That's what's going to drive your share price higher over the long term. That's in US dollars as well. And there's its guidance for this year. This was done earlier in the year when gold, the average price was around 2,000 per ounce. You're at 2,600 an ounce right now. They will best this guidance, which is great to see. Investment thesis here. If you're looking for a 10x stock, we think this company had potential from about $1.50 to go to $15. That's our 10x potential on this. You can see they got this strong balance sheet to allow them to grow the business over the long term. They don't have to go to the market and continually issue shares to fund. They will expand. They have one successful mill in Peru. We expect they can expand that mill, but they can also go out. The plan is to have 4 mills over the next 3 to 5 years. They've started a test plant mill in Senegal, just announced recently, about 50 tons per day. Their existing mill right now is about 500 tons per day, so 10 times larger, but they want to get this mill to that level over the next 3 to 5 years. There's other Latin American country they're looking at right now. Whether they buy a mill or build it, they have the cash to do that without diluting you. That's what we like to see. So your 10x case here from $1.50 to $2, that range when originally recommended it, they build those 3 plants. They produce the same revenue in those 3 plants that they produced in the existing plant, and you have about 50 cents per share in earnings from each of those plants. You fire a 10 times multiple on that. If they have $2 per share, you can get to $20. Does that help? Hopefully. Good. That's our 10x thesis on this company. Strong dividend growth stock, 2.4% yield, keeps going up every year. Our effective yield means when you originally bought the stock, what you're getting paid on it is about 9% now, which is great to see. We expect that to continue to grow over the long term. It trades at cheap valuations, 8.3 times earnings, 5.9 times cash out, despite the fact that the stock is up about 300% for us. That's our fair value. We're very conservative in this value. This doesn't factor in new mills. If they bring on new mills, this company can have a higher fair value. Again, this gold pricing environment drives small scale engagement. It's great for the business, and they'll continue to be more and more profitable. This is the next company we're going to talk about. It's outside the mining industry, but it is a company we just recently added to coverage midway through this past year. We're able to buy it at 78 cents. They trade around $1.50, $1.52 today. Higher risk, operating primarily in Saudi Arabia, but high-end customers from all over the world. IT firm essentially servicing the financial industry is big for them, but there's a number of other industries. They are benefiting from some massive capital spending in that area of the world. We'll talk about that quickly here. Revenue in the last quarter up to $14.7 million. Adjusted earnings jumped about 140%. Net income was 5 cents per share, where they made about 1 cent in the same period last year. Again, earnings per share driving the stock price. That's why you've seen it go from 78 to about $1.50. Now, investment thesis here, there's that strong revenue and earnings growth within the Saudi Arabia market. There's a Vision 2030 plan, and they're doing about $1 trillion in terms of investment in this sector. That is what we like to see. But is that actually producing results for the company? Yes. They have a record backlog right now, as you can see here. They just signed a $53 million contract in the last quarter. To give you an idea of how significant it is for this company, they will do about $50 million in revenues this year. They signed a contract, one contract that is bigger than that. Again, that's why you see the share price moving higher. That's your revenue growth over the past 5 years. Projected in terms of red there is their guidance for this year. Analyst estimates and our estimates is about $75 million for this coming year. Where is adjusted earnings? Adjusted earnings here are relatively close to EPS too. This would have them earning about 24 to 25 cents this coming year. So again, that transformation, I'm going to have to go quickly here. Backlog of work online, 9.2 times EPS, 6.3 times our estimate for next year, so cheap. We expect them to exceed $73 million in revenues next year. If you apply a 10 times multiple to the 24 cents, gets you to $240. That's where we think it can go over the course of this next year. Now, this isn't a sexy company at all. It's an asymmetric return potential, we think. They build large molds for vehicles, like they do it for Tesla, in their giga presses. It's a good business, trades about $7.50, pays a 5.6% dividend. I think it gets worse before it gets better in this business, but the projections for earnings for 2026, they're already a quarter into 2025 here, are for them to earn about $1.50. If they earn $1.50, you put a 10 times multiple on that, you got $15. That's what we like to see. Asymmetric return. Your downside is about to the $6 range, upside $15. Final company, VersaBank. We bought this at $6, $7. We'd buy it today, not for what it's going to do this year, but because of what they're going to do over the course of the next year. They're expanding into the US market. They have a great point of sale solution in the Canadian market. They're now expanding that into the US market. It's a 10 times return potential from there, from about $77. 10 times as large market in the US. We'd buy this company right now. All right, that'll finish me off. We do have a new recommendation coming out next week. Supportive to the mining industry, profitable and growing, unknown, trading at just over 4 times earnings. Goes out to our clients this week. Thank you very much.